Hello everyone. Just received another small order of silver Britannia coins. Prices were coming down pretty substantially and I thought it was a good time to get stacking. I don't know about anybody else, but I prefer to buy when no one wants gold or silver. It's hard to time the top or bottom, but let's talk about latest silver price drop. I also had some interesting information regarding why premiums on bullion are so high at the moment. So to my mini monster box. I think it really helps to stay focused on my stacking target. Maybe it's just timing. If you are buying now, prices are way better than what they were just few weeks ago. Maybe this helps me mentally, I don't know. But with this 100 coin target, I can clearly see my progress and look forward to the next step. With this latest addition I will have 2.5 tubes, which would be a halfway to my goal of 100. And since it looks like silver is on sale, I just ordered another 10 coins. We'll receive it next week. It is a slow progress, but it is moving forward steadily. I think the gold is on sale too, so maybe I'll pick up a half ouncer next week if I have some extra cash to invest. Let's talk about recent price action around spot silver and then we will talk about why I think premiums on bullion are high and how long it will last. So what was happening to the prices of silver last week? I think the main concern for the prices of silver is industrial demand. We all know that in 2021 demand for physical silver went up by 19%. 2022 is shaping up to be another record year in this regard. Most of that rise in demand came from coins and bars. It's not a secret, inflation expectations are rising, so everyone is trying to find some ways to protect wealth. So this aspect of silver use is driving prices higher. But with recent economic news showing slowing down of the manufacturing, it was not a surprise to see price of silver to slide down. Add to it strong job report in the US last week, and you have another reason to expect an aggressive hike from the Fed. That pushes the dollar to the new highs. This is what's dragging prices of silver down in my opinion. Some of you took a quick poll on my channel this week and most of us agree, that at least for time being, we have a bottom in gold and silver prices. If you want to cast your vote, you can check out our community tab, input your opinion. But what I wanted to share with all, was my conversation with a local coin shop owner regarding premiums. I was always wondering how bullion dealers hedge the risks of price volatility. Silver spot price can move 10% a week. Say if I walked into a shop and bought few American Eagles and price went up next day, dealer would have to buy at a higher price to get the inventory they need. And it can take few days to replenish the supply. It's not always predictable. But that is not the worst. What if a dealer bought some silver and the spot moved down? Now what happens? Would dealer wait for the price to come up? But what if that would take a few months? From what I understand, dealers are making money by buying and selling, so inventory has to move fast. If you have 5 consecutive 10% losses, think of how long can you stay in the business? So I asked how they manage the price risk. What I have heard actually made sense. They measure, or rather, maintain inventory not in dollars, but in ounces. That was the answer. Say they have 100 ounces of gold and 500 ounces of silver in inventory. If I buy 5 ounces of silver, all they have to do is to buy the same amount from a wholesaler same day to bring the inventory back to the 500 ounces and pocket the difference. So ideally dealers maintain a constant number of ounces. That got me thinking and I kind of noticed a pattern. I'm familiar with stock market makers' strategies. It appears to be similar in action to any bullion dealer strategy. Market makers on a stock market just hold positions to have enough to be on the other side of each trade. But as most of us who trade stocks and derivatives know, in times of high volatility, the difference between bid and ask skyrocket. You can think of that as premiums for the bullion. This is not due to greed, well, might be. But it mostly due to the risks that market maker would have to replenish inventory at some unfavorable price due to a rapid movement of prices. If you watch the bid-ask spread in any stock right after say Fed rates announcement, you will see a huge gap. Say normally you would have a spread of 0.01 on SPY, but it can widen 10 times or more during volatility. So how that applied to gold and silver prices? Same thing. Dealer has to account for the risk that they will not be able to replenish inventory during volatility in spot prices. And it makes sense. In silver, we have seen a major volatility in the last couple of years, so premiums are the dealer's ways to protect their inventory. In a nutshell, premium is a cushion. If price of silver or gold moves away from the price they sold you, they have some room to recapture losses. If you consider gold, the premiums are way lower because the volatility in gold is way less. To take it a bit further, let's make some predictions regarding silver premiums. If the thesis is correct, we should see sizable premiums to persist until the volatility in the market subsides. That is just a theory, but it makes sense to me. I am curious, what do you think? If you think I am right, please comment. If you think I am wrong, please tell me why again in the comments. Premiums are obviously affected by many factors, but I think the market volatility is one of them. Now, the clear deviation is a price of silver eagles. That is a supply issue, I think. But if you compare other forms of silver bullion, the spread between buy and sell prices is very consistent. So there you have it. Just my thoughts on premiums and silver prices. I hope this video helps with your stacking goals. Thank you so much for watching, and if you like this video, please subscribe and like. Until next time.